Chapter 18, Taxes Affecting Real Estate. Talking about our property taxes. The property taxes that we pay for is what provides local government with the revenues that they need in Florida in order to operate. They account for a large portion of the revenue needed to provide the law enforcement, fire protection, and other services. Okay, Florida's taxation process. Florida taxes property taxes on a calendar year. January 1st it begins, December 31st it ends. March 1st is the filing deadline for your homestead for any homes purchased in the year previous. April 1st is the time that it becomes delinquent, the year's taxes, the previous year's taxes. If they're not paid by the following April 1st, they become delinquent and tax certificates are sold. Then November 1st, you can start paying the current year, the one that became a lien on your property January 1st. And December 31st is going to end that current year, but remember, you'd have till April 1st of the following year to pay your property taxes before they're delinquent and they sell tax certificates to collect the money. Determining just value, the taxation process. Ad valorem means according to value. I told you that taxes are levied for a calendar year. They're paid in arrears, which means they come due January 1st, but not until that's November of the same year do we have to pay them. And we have to the following April to get them paid before they're considered delinquent. And that's the tax schedule. Just value minus objective valuation is your assessed value, which is what is established for tax purposes, what you're going to pay your taxes based on, your assessed value. And then October or before, you'll get what they call a trim notice, and it's an assessment for the next year coming up, and it tells you what you can expect, what they look to pass as the new taxing structure. Now, if you don't like what they got to say, if your taxes are going up, way up, you can always protest. The first thing you're going to do is contact the county property appraiser or their representative. If that doesn't work for you, you're going to appeal to the Value Adjustment Board, which has 2 county commissioners, 1 school board member, and 2 citizens of the county. If that doesn't work for you, you can always litigate, which means filing suit against the property appraiser or tax collector, and good luck with that. The answer is between one of these two. Either immune property, which is government properties that aren't assessed or taxed, or exempt properties, which are like churches and nonprofits. They're subject to taxation, but they're released from the taxes. So to remember the difference, whether it's immune or exempt, remember what happens is they'll give you a big old long scenario. Question asks you, is it immune, exempt, partially exempt, or other exemption from property taxes? If it's immune, it's because it's government property. Think of government immunizations that we have to have as kids going to school. That's how I remember immune is government. Exempt is your churches and nonprofit. They're exempt from taxes. Now, you wonder, well, why are they going to be assessed every year? That's because if a church or a nonprofit sells its real estate to someone who is not another church or nonprofit, they're going to owe taxes for that portion of the year. There's got to be something to base it on. So that's why it's subject to taxation, but released from the taxes. To qualify for homestead exemption, you got to be a permanent legal resident in Florida, and you can only have 1 homestead. You have to hold title to the property by January 1st to be able to claim homestead that year. That means legal title, and it has to be your residence. And within that first year, you have to file with the county property appraiser on or before March 1st in order to get it for that year. If you don't, then it's going to be another year before it becomes in effect. So your assessed value now of the homestead. The first $25,000 of that assessed value is exempt from all tax districts. Florida has 3. You have city, county, and school board. If your value is above $75,000, the city and the county will let you reduce your assessed value by another $25,000. So for example, let me put this in a picture for you. Let's say your home is assessed for $80,000. For city and county, you're going to be able to take $50,000 from that and only pay taxes on $30,000, city and county. Your school board, however, they're only going to allow you to take that initial $25,000. So 80 minus 25,000 is 55,000. So your school board taxes is going to be based on a value, an assessed value of 55,000, where city and county is based on 30,000. Additional exemptions, $500 exemptions for surviving spouse, legally blind, or a non-veteran who is totally and permanently disabled. Now these exemptions are cumulative, which means if you have one, you can be exempt $500. If you have two of the three, you're exempt $1,000. If you have all three of them, you're exempt $1,500. Now, if you're a quadriplegic who's totally disabled from the neck down, you're exempt from paying property taxes. Disabled veteran and first responders exemption. Today there are specific exemptions for first responders. You just need to know that there are exemptions for them, but your disabled veteran, they've got it kind of lined out for you. If the veteran is at least 10% disabled by a military-connected service misfortune, they can reduce their assessed value by another $5,000. If they have it and it's not service connected, then they can't, even though they're a veteran. So watch for that question. They'll be talking about a veteran, and they'll talk about that veteran being either partially disabled or totally disabled, but they won't say it's due to a service connected misfortune. So you'll end up giving them exemptions that they're not qualified for. So watch out for that. Now, if they're totally and permanently disabled, again, due to a service-connected misfortune, they are totally exempt from property taxes. And this includes surviving spouses of veterans who die on active duty. To figure out the taxable value, we're going to take that assessed value that I told you they're going to go and assess your property for. Then you're going to subtract any exemptions you have, and that's your taxable value. That's what you multiply times the millage rate, which we'll get to in just a minute. Okay, that's your taxable value. Remember, over $75,000, you got two different taxable values. Your assessed value is the same, but your taxable value is different because 25 is reduced for school board, but for city and county, it's 50. There is an amendment to the Florida Constitution to save our homes. What it does is limit the increases to assessed value for homesteads. Now, not for your investment property. We're talking about your homesteads, one that you claimed homestead exemption on. What happens is the most it can go up is 3% annually, or the consumer price index change, whichever one is lower. So if the consumer price index change is 2%, it can only be increased by 2%. But let's say the CPI index, the index change was 5%, then the most they can do is 3%. And the Save Our Home benefit is market value minus assessed value. Florida's Greenbelt law is for agricultural land. The assessment is based on the use, not the highest and best use. Because if it was, farmers could not pay their taxes. And it's a law to assist farmers in having reduced taxes because they're growing food, okay? And it requires annual classification. The way to determine the annual property taxes due is you take that taxable value. Remember, we subtract the exemptions from the assessed value. So now we got the taxable value, and we're going to multiply it times the tax rate. The city, county, and school board are each going to have their millage rate that we're going to tax the taxable value by, or multiply the taxable value by. Tax rates are expressed in mills. A mill is 1/1000th of a dollar, or 1/10 of a cent. Now, for each one of those school, city, and county millage rates, they can only go up to 10 mills. Now, the best way to know how to figure out this tax rate millage thing when you're doing your math is you've got to move the decimal over 2 spaces. The easiest thing for me to remember, if it's talking just about the whole numbers, if it's 1 mill, you're adding 2 zeros. If it's 10 mills, it's 1 zero. So 1 whole number, 2 zeros. 2 whole numbers, 1 zero. And of course the decimal goes in front. Special assessments are one-time taxes. Now they show up on your property tax, and they can be over a period of 20 years. What they're taxing is a public improvement that the municipality has put that benefits you, the property owner. Could be street paving, could be hooking you up to sewer lines, but remember, it's not an ad valorem according to value property tax. It is a special assessment, and it's levied on a front foot basis if we're talking about street paving, or a hookup basis if we're talking about sewer lines. Let's go back to liens on the property. Remember when we have the proceeds after the house sales and we got the bucket of money? Remember, this is one of the main ones that's going to get paid off. And remember, they're in this order. All property taxes are going to get paid. Then any special assessments. And then any estate tax. Not IRS, but estate tax, like probate tax. Then they go on to pay the mortgages and everything by order of date. Okay, I told you had till April 1st of the following year to pay your taxes for the previous year. If you don't, this is what's going to happen. Property tax lien is superior to all other liens. Remember, I just told you we're going to pay all that property taxes off, then we're going to go to special assessments. Okay? And I told you if you don't pay it by April 1st, they're going to issue a tax certificate because the county or city needs that money to pay their firemen and their police and other, amenities that we have. What happens is they're sold off and the people bid on an interest rate. They start out at 18% and they go down until the lowest one, and the lowest one wins the certificate. So what happens is that investor goes and pays that, and the property owner now owes taxes plus accrued interest of whatever interest rate that investor got. Now, it's not up to the investor to collect on the taxes. The taxes are still owed to the city. So when they get paid, they get the tax certificate redeemed, and the investor will get their money then. Okay? If they do not pay their taxes after 2 years, but before 7 years, in Florida, they can ask for a tax deed process. What happens there is they put the house up for foreclosure on all the back taxes. And that's where you've seen these infomercials at midnight. Buy houses for back taxes. That's what they're talking about. Tax benefits for your principal residence. If you itemize mortgage interest and property taxes on both the principal and second homes are deductible. Also, first-time home buyers can make an IRA withdrawal without penalty. Additional tax benefits for home ownership, again, if you itemize, is interest on a home equity loan, up to $100,000, and mortgage origination and discount points. It's deductible for the year it's paid, unless you refinance. If you refinance, it's spread over the life of the loan. When you sell your homestead, your principal residence, there's some exclusion on paying capital gains from the sale. So, as a single person or a married person who files their taxes separately, you can claim up to $250,000 profit and not have to pay any taxes on it. Now, if you're married and file jointly, it's $500,000. So that's a nice benefit. Now let's talk about deductions for investment properties from the gross income. Because you're making money on this. You can take off the operating expenses, the financing expenses, the mortgage interest, depreciation. The one thing you can't do is you cannot take reserves for replacements off of your gross income for investment properties, even though it's called an operating expense. Because, and they like to use this question because people get confused on it. Remember I told you it was a savings account. And it's a savings account, and therefore the IRS is not going to let you say, oh, I got $10,000 I'm going to spend next year. I want to take it off my taxes. You're not going to get to take it off your taxes until you actually spend it. Once you spend it, then it comes another line item that's deductible. But as it sits as a reserve for replacements, that's a savings account, and it's not deductible. Okay, the IRS allows us to depreciate our investment property, and it's done by straight line depreciation, and here's your formula. Total cost to acquire the property. What did it cost me in total, not just the price of the property, but in total for the property, minus the land value, because remember you can't depreciate land, and that's going to give you your depreciable basis, the figure you're going to work with. Basically, it's the property minus the land value. Okay. Now, when you go to depreciate for IRS purposes, you're either going to divide it by 27 and a half or 39 years, and they're going to want you to know this. They're not going to tell you this. So the way to know which one is which, 27 and a half years are for investment properties that people live in. It's not 1 to 4. It could be a 1,000-unit apartment complex. But if people use the property as a home to live in, you're going to divide it by 27 and a half. If it's a shopping center, office complex, non-residential investment property, then it's 39 years. Capital losses can be used to offset capital gains for tax purposes. So what that's saying, vision this, you made $100,000 on this property, but you lost $75,000 on that property. You're only going to be taxed for $25,000. That's what we're talking about, offsetting. Capital gains are going to be taxed at the applicable capital gains tax rate. Now watch this, because they'll throw this in on a question on you, possibly try to distract you. The loss on the sale of a principal residence, your homestead, is not a capital loss. So the question I've seen floating around would be something like, okay, Marlene made $50,000 this year. She made $50,000 on investment A, lost $25,000 on investment B, and lost $10,000 on her principal residence. What is her taxable income? So you're going to include everything except that principal residence, that $5,000, that last one I told you. That one don't count. So $50,000 plus I made $50,000 is $100,000, but I lost $25,000, so that's $75,000, and then the principal residence doesn't count. Watch for that question. Investment property. This is called FL.LECTURES. Purchase of U.S. real property from foreign sellers. Okay, when a foreign seller that's not a citizen gets ready to sell property they own in the United States, they have certain requirements they've got to abide by. This is aimed to prevent foreign sellers from avoiding paying taxes, because once they get on that plane and don't come back, government can't get the taxes from them. So what happens is the IRS requires buyers, yes, the buyer, to hold 15% of the gross sale. The most important part of that is 15% that you know for testing purposes, okay, and that the buyer must withhold it. Then the buyer has to report the purchase and pay the IRS the amount withheld. So basically what this is saying, let me put it in a picture for you. So you're the seller. No, I'm sorry, you're going to be the buyer. So you're buying a house from a foreign seller. The house sells for $100,000. Because this is a foreign seller, the IRS is requiring you hold 15%. So what's going to happen is you're going to pay the foreign seller $85,000 and put $15,000 in a trust account. Then the IRS comes in, takes what they need. If there's anything left over, that goes to the seller. That's still their money. It's just that you have to put it in a safe place for the IRS until they can tax it. Sale of real property. Capital gain is the profit from the sale of real property. We're talking about investment property, not your homestead, not your principal residence. Taxable gain is determined by the amount realized from the sale, which is your sales price, less your expenses of sale. So let's say you sold your investment property for $200,000. It cost you $20,000 to get it to close. The amount you realize from the sale is $180,000. Then we go on to the adjusted basis. That's the owner's original cost, we'll say is $100,000, plus expenses to get it to close, and any capital improvements maybe you had to do. So we'll say the original cost was $100,000. Had expenses of $10,000, that's $110,000, and you put a $15,000 roof on it. That makes your adjusted basis $125,000. So what you're going to pay for capital gain is at $180,000 minus $125,000, and that's what you're going to be taxed on. The amount realized less the adjusted basis. You can't get rid of capital gains tax, but you can defer it. And there's two ways to do that: installment sale method and like-kind exchange. With the install sale method, the gain is received over a number of years, and the seller pays the capital gains taxes as it's received. It's not all due at once, it's just as he receives money, then he pays it in that year. If it's a loss, it must be reported in the year of the sale, though. Like-kind exchange, known as Section 1031. You're selling real property and buying real property. And when it says like-kind exchange, it doesn't mean if you sell an apartment complex, you got to buy an apartment complex. You're selling investment, you have to buy investment. You can't sell investment and buy a principal residence and do a 1031 exchange on it. That don't work that way. Okay? They have a lot of rules and regulations. An attorney needs to do it. You can't touch the money. It's got to stay in a trust account, all kind of things. But they also want you to know that any personal property or money exchanged to even out values is called boot. So basically, if you sold your apartment complex for $200,000 and you bought the next, well, it don't have to be apartment complex for apartment complex. You sold an apartment complex and you bought a, office complex, and you only paid $180,000 for it. That $20,000 that you're going to receive back is called boot, and it's subject to taxes. The rest of that is not subject to taxes until you take hold of it. You actually cash it out, so to speak.